A bull market does not last forever, and to truly build wealth through the stock market, here are 5 rules you cannot ignore. Hi guys, Stanley here. The US market has been performing very well this year thanks to many of the tech stock. But stock market in Asia has been having some mixed performance. Traditional blue chip like banks, telecommunication, and even property stocks have not been performing well. Yet, stocks within specific sectors like healthcare or technology have been experiencing some of their best rally in years. For example, a company like Top Glove, listed in Malaysia, or Meituan Dianping, listed in Hong Kong, have seen their share price shot up 460% and 170% respectively this year. Congratulations to you if you have enjoyed some gains this year. But even if you have not, don't worry. The good thing about the stock market is that the opportunity will always be there. And the key to finding success in the stock market is not just about picking the right stocks. It is more about how we behave within the stock market as well. So here are 5 key rules that can help you increase your chances in finding success in the stock market. Number 1, be a long-term investor. If we want to build long-term wealth, we have to be long-term investors. Sounds simple, but it is very hard to do. Being a long-term investor means that we have to focus on investment that will give us good return over the long term, instead of just investing in whichever is the hottest trend right now. For example, the pandemic has made the healthcare sector very attractive right now and made company like Hartleger Holdings, a glove manufacturer, return more than 200% this year alone. However, if you believe in the long-term demand of glove, long before glove become a trending sector, Hartleger has actually returned more than 110 times their capital over the past 12 years for their investors. So, by looking further down the road, when investing pays a long way. Next, build your portfolio over time. You know that the portfolio is safer if it is more diversified and have more stock. Based on most investment book, having a portfolio of about 15 to 30 stocks would be a good size. However, you do not have to buy 30 stocks all at once. It is okay to just start with 1. It is because if we are planning to create a long-term portfolio, we can buy our way into a diversified portfolio. For example, if you are able to save and invest in 1 stock per quarter, that means that you can buy 4 stocks in a year, and you can create a well-diversified portfolio within 4 years. So take your time, there's no need to rush when it comes to investing. Investing is really a marathon, not a sprint. Remember the story of the tortoise and the hare. Be the tortoise. Number 3, be comfortable with volatility. In the past 14 years that I have been investing, my portfolio has saw declines about 30% of the time. But that's okay. Even in this year alone, my portfolio saw a 10% drop during the first 2 months and then a 30% rebound after that. The stock market is always moving up and down, and we have to make ourselves comfortable with the volatility. This is because, as Benjamin Graham said, the stock market is a voting machine in the short term, but a weighing machine in the long term. So if you're confident that you're investing in high quality business with good long-term prospect, then there's nothing much to worry about even if your stocks are falling once in a while. Number 4, add to your winners, not your losers. One of the most misunderstood saying in the stock market has to be buy low, sell high. For one, we have to first learn how to tell if a stock is low or high. A company with low stock price does not always mean it is a good buy. We have to understand the value behind the company that we are investing in. Let's play a little game. Tell me what you will do in this scenario. Say 5 months ago, you invested in Amazon at $2,400 a share. Today, it is trading around $3,400 a share, and you made $1,000. So what will you do? Will you hold or will you sell? Now, you have another stock, Singapore Airlines. You bought it at about $9 a share, and today it is at $3.60. You're losing money on this stock. What will you do? Will you hold on to it or will you sell? Most of us will end up selling Amazon because we want to lock in our profit and hold on to SIA because we do not want to realize our losses. Yet, if we use that strategy, sooner or later, our portfolio will be filled with just losing stocks alone. And if we study Warren Buffett closely and how he's able to grow Berkshire Hathaway portfolio to close to $300 billion today, you will realize that he is doing the exact opposite. He's buying and holding on to his winners or selling off his losers. When he realized he has invested in winning stocks like Apple, he buy more of it. But when he realized that he has invested wrongly, say into airline stocks or into companies like IBM or Tesco, he sell them off right away. Completely opposite of how most people invest. So don't invest like everyone else, invest like Buffett. Add to your winners, sell your losers. And lastly, number 5, learn to be passive. In our society, we tend to equate action to results. If we want better results, we have to put in more action. Say if we want to be better at playing the piano, we have to put in more practice. But interestingly, that is not how investing actually works. Because in investing, the general market tend to increase over time. The S&P 500 index has increased more than 200% over the past decade. That means that if you have just invested in the market and don't do anything at all, you would still have tripled our investment. Yet most investors, even professional investors, don't achieve that kind of level of return. And that is because we feel that if we want to make more money, we have to put in more action. And that means trading more. But when we trade more, what will most likely happen is that we will make more mistakes as well. In investing, our greatest enemy is actually ourselves. So to build wealth in the stock market and create real passive income, we must first learn how to stay passive. In my personal portfolio, which I share with our VIA club, the biggest gain that I have enjoyed over the past few years is coming from stocks that I have just bought and sometimes forgotten about. To be passive in our portfolio, we have to be very confident in the stocks that we pick. That means that you can take your time when it comes to choosing the stock you want to invest. For example, when I first invested into Tencent Holding, one of the largest tech companies in China, it took me 3 years of researching and monitoring it before I invested in it. But once you have invested in a stock and you're confident in it, just leave it alone. You'll be surprised what will happen to it. And that's the 5 simple rule that might help you find more success in the stock market. If you want to find out more about how to find great companies to invest in the long term, check out our free investment course at valueinvestasia.com/free course. There you'll go through a full 15 lesson course where we'll teach you the basic of finding, analyzing, and valuing a stock. Click on the link below to get started right now. Anyway, that's it from me. My name is Stanley. Till we meet again, invest safely.